Welcome to Trading Strategies for June. I'm Scott Gamm. This month, we're focusing on how the 10-year Treasury yield affects the stock market and how you can profit from its daily movements, which for most of this year has gripped the stock market. And for that, we have a stocks specialist, Kristina Hooper, Chief Global Market Strategist at Invesco, and a bond specialist, Collin Martin, Fixed Income Strategist with Charles Schwab. And it's great to have both of you back on the street. Thanks for joining us.
Great to be here.
So let's talk about this because investors have been so worried about the 10-year Treasury yield for all this year. So Kristina, how does the 10-year yield affect the stock market, generally speaking?
Well, typically what we've seen is that anytime there's been an increase in the yield on the 10-year, especially if it reaches a key level, that places downward pressure on stocks. It creates a re-rating of stocks for several different reasons. It impacts valuations, but also it competes with stocks in terms of yield. And as the yield on the 10-year increases, it looks more attractive relative to stocks, so it can certainly draw flows away from stocks.
Because stocks are inherently risky, and investors are saying, well, if I can get a decent return on a bond, why go into the stock market?
Exactly. And financial repression really forced investors to at least consider stocks for an adequate yield. But now that yields are coming up in the bond space, it can look more attractive, especially those that are technically risk-free.
Collin, what do you make of that? I mean, explain the significance of the 10-year yield.
Well, I'd follow up on what Kristina said in that we think this is an opportunity. You know, a lot of times investors get to be concerned about the risk to rising rates, what that means for their portfolios, because higher yields mean lower prices. We think it means this is an opportunity to earn higher yields, and we always like to point out that the returns actually aren't that bad. So we've seen 10-year Treasury yields rise pretty high this year. We saw them hit over 3.1%. Year to date, the aggregate bond index is only down around 2%. Treasury indices are down 1%. Short Treasury indices are down less than 1%. So the drop in prices isn't really that bad, and the income payments that they provide can help serve as a buffer to those price declines, and those yields have risen, and so investors today can earn higher yields.
And we'll talk about asset allocation later in the program, but I do want to talk about the stock market reaction to the 10-year movements over the past couple of months. We started the year at 2.46% in the 10-year. Towards the end of April, we hit 3%. This was that critical threshold that the market decided they were going to worry about. And then the market dropped 1.3% on April 24th. So we did see that negative market reaction when the 10-year hit 3%. We then hit 3% again later in May. We hit 3.1% in May, and the S&P 500 rose 0.7%. So that doesn't make much sense. Explain why we saw those bizarre market reactions to the 10-year yield.
Well, I think it makes sense when we saw those re-rating of stocks downward because, of course, it calls into question valuations on stocks. It makes bonds look more attractive relative to stocks for all those reasons. Every now and then, though, particularly as the market becomes accustomed to higher yields, it doesn't react as dramatically and, in fact, could be focusing on other information. So that's my explanation for what seems a bit aberrant in terms of market reaction.
But is the 10-year yield, when we're talking about a difference of a few basis points, is that noise for the markets? I mean, should it change your strategy at all when you're investing?
You know, for our clients at Schwab, we don't think so. We look at the big picture and whether the 10-year Treasury is at 3% or 2.9%, that's really not going to change our advice going forward and what investors should be doing today. One thing that we like to point out is that we don't think yields are going to rise too much further from here. You hear a lot about the risk to rising rates, maybe going to 3.5%, maybe even 4%. We don't necessarily think that's going to happen. One thing that we look at is the relationship between 10-year Treasury yields and where the Fed funds rate peaks in a given cycle. And we look at projections from the FOMC about where they might be in a few years and where they might be in the long run. That only gets you to the 3%, maybe 3.25%, 3.5% range, which is not much higher than where we are right now. So we think much of the move higher in long-term yields has actually already happened.
Kristina, do you agree with that outlook?
I would actually say that over the longer term, I think we could see the 10-year get to 4%. But for the coming months through 2018, I would expect we see a wide trading range from about 2.75% to about 3.25%. And that we see a fair amount of volatility for the 10-year yield because there are just so many forces at work that are pushing down but also pulling up the 10-year yield.
I guess the question is, at what level in the 10-year does that really start to threaten the case for owning stocks. You mentioned 4%.
Right.
Do you think that would really crater stock valuations like we know them right now?
No, I don't, because at the end of the day, the 10-year is viewed, the yield on the 10-year is viewed as an expression of expectations for economic growth plus inflation. And so, from my perspective, if you get to a 4% on the 10-year, that's a sign that the economy is growing and that there are a lot of positive reasons to have exposure to stocks.
And Collin, the 10-year yield moves very slowly. When we hit 3% in April, that was the first time since 2014. So if, Kristina, if you are right that the 10-year is headed towards 4%, I mean, it could take years.
It could take years, but I would agree that it could happen. It could happen relatively quickly. I would agree with all the positive things that are leading to higher yields, and that's what we like to point out with the rise in yields we've seen all across the curve. They're rising for good reasons. Economic growth is positive and growing. Inflation and inflation expectations are increasing, so things are generally good. The Fed's hiking rates for good reasons. We just think in the near term, what the expectation for future Fed rate hikes, and also some of this volatility we've seen in the markets, could kind of trump that and keep a lid on yields in the near term.
Kristina, will we be watching economic data in the coming months through the lens of the 10-year? I think that happened a little bit with Friday's jobs report. Everyone was wondering how the 10-year would react. Not necessarily how the market would react, but how the 10-year would react.
Absolutely. I think that's going to continue as we move forward. That we look at economic data now in terms of what the Fed might do, as well as what the reaction is going to be in terms of the 10-year yield. Don't think that's going to change. However, what I do think is going to happen, and we've already seen this occur in the past, is the fear trade is also a powerful force. And so when we see something like the Italian crisis, the potential of acquittally, it can drive down the 10-year yield. And so we have to expect that there will be those flare-ups this year. And that's why I expect a pretty wide trading range and a lot of volatility in the 10-year yield.
And we should remind everyone that this whole 10-year yield worry came into play in early February when we got a better than expected wage growth number for January. I think wage growth was 2.7 or 2.8% year over year. And that caused everyone to worry that the Fed might raise interest rates faster than expected. Is that an accurate depiction of what happened?
I think that's absolutely accurate, but I would add in another wrinkle, which is that I don't think it's a coincidence that the same week we saw that happen was the week that the reins of the Fed were turned over from Janet Yellen to Jerome Powell. And with it, entered in a lot more uncertainty about the FOMC and what it will do this year.
Mm-hmm. Collin, what were you telling clients back in February when we had that inflation scare? Were you getting calls, and were people changing their strategy?
We do get concerns a lot, especially when yields are rising. When they see those price declines, it tends to spook investors. Our main advice is to stay the course. When there is volatility in the markets, the best case scenario for us is to not hear anything, because our clients are already well positioned and understand how the various parts of their portfolio are going to react. What we've been focusing on for the past few months is to actually shorten the duration of your portfolios.
And why is that?
Now, because of the risk to rising yields. Longer term bonds are going to be more sensitive to rising interest rates than shorter term bonds are. So if our expectation that short-term rates and even long-term rates to agree are going to continue to modestly rise, we'd prefer to limit the average maturity, limit the average duration to reduce that interest rate sensitivity going forward.
So then I guess the discussion should shift towards stocks versus bonds, because if you were just in the S&P 500 this year, we're only up 2.6%. Maybe fixed income was a better route so far this year, and you didn't have to worry about the 10-year or tariffs or all these other manufactured crises that the market kind of made up.
Well, we always think it's a stock and bonds discussion. To make a big move like that, to shift from these major asset classes would be pretty decisive, and that'd be too much, I think, for a lot of what our clients at Schwab are doing. But we always like to point out the benefits that fixed income investments can offer to an overall portfolio. We saw it last week when we saw a lot of volatility because of concerns over in Europe with the Italian elections. We saw the S&P 500 down about 1% in a day. We saw Treasury returns up 1%. We saw long Treasury returns up over 2%. Shows the benefits of owning Treasury securities. When there are these bouts of volatility, they can help lower the overall volatility and help offset some of the price declines and some of the riskier parts of your portfolio.
So is there a certain asset allocation mix of stocks versus bonds that you like to recommend? And if so, how often should people be changing that allocation?
It all depends on the client. What's your risk tolerance? What's your investing time horizon? We think that's really going to dictate it. That's going to depend. That's going to dictate how conservative or how aggressive you want to be. In terms of how often should you review it, at least once a year, preferably more, to make sure that the risk and return characteristics of your current makeup match that investing horizon.
But generally speaking, someone older perhaps should have more exposure to the fixed income side versus someone who's younger. Someone who's younger has the time to recoup any losses in the riskier stock market.
We would think so. If you're in or near retirement, having more fixed income investments would probably be better.
And Kristina, we hear this advice all the time, but I think it's worth repeating for people.
Absolutely. I think diversification is critical, not just between stocks and bonds, but within stocks, within that stock sleeve, within the fixed income sleeve. There are so many different ways to derive income. And quite frankly, one way is through stocks. You had mentioned that we're only up 2.6% this year. But if we were to factor in dividends, particularly if we had a relatively high dividend yielding portfolio or a portion of our portfolio that was higher dividend yields, then that return would be substantially higher than just 2.6%. So there are a lot of ways to get income, and one of them should be stocks.
Are you expecting an up year for the S&P 500 in 2018?
I do expect an up year, but nothing spectacular. From my perspective, I think we could safely expect a return of between 6 and 8% approximately. But if you had dividends, that of course would augment that return.
So Collin, if Kristina's right and we do end the year positive for the broader stock market, are there any changes you should be making in your fixed income portfolio right now to prepare for such a dynamic?
Not necessarily. Right now we think investors can be focusing on shortening their average duration, but also we're somewhat limiting the credit risk in our overall portfolios. When I talk about credit risk, I'm talking about things like corporate bonds, emerging market bonds. Investors just aren't really being compensated too well for the risks involved. So for most intra fixed income asset classes, we have a neutral outlook. Again, you're not getting compensated too well. If we were to see some bouts of volatility, maybe some risks in the stock market that led to spreads rising a little bit, maybe we'd rethink that. But for now, we think investors should play it relatively safe, up in quality, and focus on short duration investments.
And investment grade floating rate notes, can you explain those? And
Absolutely.
what role those should play in your portfolio?
Yeah, we think investment grade floating rate notes, or floaters as we call them, can be a really good way for investors to participate in Fed rate hikes while also seeing relative price stability. So these are types of investments that are issued by corporations, and instead of your standard fixed coupon rate, they have floating coupon rates. They're benchmarked to short-term interest rates that tend to track the Fed funds rate. So as the Fed keeps hiking rates, the coupons on these investments should continue to rise, meaning investors should be rewarded with higher coupon payments, but they're also investment grade. We think that's important right now. We're focusing on higher quality investments, and over time, the prices on investment grade floaters tend to be relatively stable. So because their coupons are adjusting, their prices don't need to adjust lower.
There's a big debate going on right now in the stock market over whether the Fed will hike interest rates 4 times or 3 times totally this year. Is the impact for the bond market just as significant as the stock market in terms of 3 or 4 rate hikes?
Well, we think so. If it were to be 4, that would likely mean a sharper rise in most Treasury yields, which would mean a further decline in prices. We're in the camp that we'll see a total of at least 3 this year. If we were to get to that 4, we'll see how the economic data plays out as the year goes on.
But a lot of these worries are kind of shrugged off if you hold your bonds to maturity. I mean, that's a key point to remember here, right?
That's right. That's a benefit of owning fixed income investments and individual bonds. Barring default, you know what you're going to get at maturity. So the price changes between the time you invest and the time it matures, you don't need to worry about that as long as you get your principal back at maturity.
Kristina, do you agree with the sort of severity of investor worry about 3 or 4 rate hikes this year? And is that worry warranted? Is there a big difference for the market if the Fed raises 4 times or 3 times this year?
I don't think it's a big difference. From my perspective, the bigger issue is balance sheet normalization. We actually heard the other day.
No one's talking about.
No one's talking about, but I think they should. And we actually may see the FOMC talking more about it. What we saw in the most recent FOMC minutes from the May meeting was the concern amongst a number of participants in the FOMC about the yield curve, how narrow the spread between the 2 and 10-year is, and how close they're coming to the potential of an inverted yield curve. So what that says to me is that they may want to slow down rate hikes and perhaps hasten balance sheet normalization, which could, of course, spread out the gap between the 2 and the 10-year yield. Now, having said that, we also heard recently from the Bank of India, which asked the Fed to slow down balance sheet normalization because of what it's doing to the dollar, to dollar liquidity, and the kind of stress it's placing on emerging market economies. But I do believe balance sheet normalization will be a topic du jour at some point later this year.
Collin, do you agree? And respond to Kristina's point on the possibility of an inverted yield curve, which we know has a tendency to predict and signal recessions.
We do agree. It's something that's really not talked about too much. Once the Fed started allowing securities to roll off the balance sheet, it's basically been on cruise control, where each quarter they're allowing an additional $10 billion to roll off. We really haven't heard too much from them since they started it last October. But as the year goes on, and even after the end of this month, when we get to the next quarter, we're going to see a lot more roll off. 40 and 50 billion a month is a lot different from 10 billion a month, which is where they were at the end of last year. So we do think it poses a risk. Now with the yield curve, one thing that we like to point out a lot is that the Fed can just quicken the pace of roll-off if they wanted to see long-term yields rise. Whether it would be successful or not, who knows? But that is something that they could do from a monetary policy standpoint if they were concerned about a flattening or even inverted yield curve. They have a way that they could at least try to get long-term yields up.
So Kristina, what does the balance sheet normalization process mean for the bull market, which of course is 9 years old? And if you look at a chart of the S&P 500 and the Fed's balance sheet, I mean, both lines move in tandem. So
Exactly.
that you wonder what's going to happen on the way down.
Exactly. And that's why I worry so much about balance sheet normalization, because I think it has greater implications for the stock market than it has for the bond market. Because quite frankly, on the way up, it had a greater impact on stocks than it had on bonds. And so we don't know the answer, because essentially unwinding an experiment is an experiment in and of itself. So we don't know exactly how this will play out, but we can certainly make some assumptions that we may see downward pressure placed on stocks by balance sheet normalization.
Do you agree with that? Which group of investors should be more worried about balance sheet normalization, stock investors or bond investors?
Well, it's probably a little bit of both. If you are a bond investor, a concern for us would be long-term bond investors, those who hold treasuries of 10-year maturities or 30-year maturities, because they are more sensitive to raises in yields. But we do see it as a risk going forward. I mentioned before that there are plenty of forces that can pull yields higher. When you add these all together, strong growth, rising inflation, increasing treasury supply, all combined with the fact that the Fed is reducing the amount that they hold, there are plenty of forces that can lead to yields moving higher.
So Kristina, with all those forces that we just talked about, what sectors are you bullish on for 2018?
Well, I continue to be very bullish on technology. Earnings are there, revenue is there, not just through 2018, but as we look out through 2019, it's an attractive area. We're also seeing more companies spending on technology. And so if we actually see CapEx spending increase this year, which is incentivized by tax reform legislation, what we're likely to see is a significant portion of every CapEx dollar spent on technology for companies. So I think there's a big tailwind there. Beyond that, though, I would say that areas within other sectors, particular industries, look good. Financials in general look good just because rates are going up. Balance sheets look fairly good in the financial space, but to me, tech is the shining star. Now, in terms of capitalization allocations, because I worry a lot about protectionism, I would favor smaller capitalization stocks in this environment, because I think they're less vulnerable to what we're likely to see in terms of protectionist wars.
Yeah, Collin, when Kristina talks about the technology sector, which of course has been on fire, the NASDAQ keeps hitting record highs, is there any rule of thumb in terms of what bonds to buy off of that? I know you're neutral on most parts of the fixed income market, but take corporate debt, right? If tech stocks are on fire, should I be looking at debt from some of these tech companies to move money in? Is there any correlation in that regard?
Well, we take more of a big picture approach, so we don't look at it, individual industries or individual issuers. We kind of look at the markets as a whole. We do break it down by credit rating, whether it's investment grade or high yield. So one of our key points right now is to not be taking on too much risk. We're kind of playing defense in the fixed income markets right now. The way returns have been so far this year, most parts of the fixed income market have suffered losses, where income payments have helped offset some of the price declines, but not all of them. We think for the remainder of the year, it's probably going to be a similar case where much of the return is going to be coming from income payments and not from price appreciation. And we think if you're in the riskier parts of the market, again, where you're not being compensated too well for those risks, we do see a greater risk of yields possibly rising and sending those prices down even further.
Kristina mentioned tariffs. The market seems to be taking a pause from worrying about tariffs, especially after last Friday's jobs report. What do tariffs mean for bond investors? Presumably, tariffs would cause volatility, perhaps even losses in the stock market. We've certainly seen that so far this year. Does that make the case for owning bonds more attractive?
Well, they kind of have a push and pull when it comes to the bond market, because tariffs can slow growth, but they can also lead to higher inflation. We think ultimately inflation may play a greater role, so we think that would actually lead to slightly higher Treasury yields. But again, the way we're combating that is just shorten the average duration of your portfolio. You can get higher yields now than you could have a year ago, 2 years ago, and it helps, again, limit your interest rate sensitivity if we did see that rise in yields.
And Kristina, Collin brings up a great point that tariffs are inflationary, and if that's the case, then maybe I'm not going to get enough return in the bond market, and I need to take on riskier stocks to hedge my positions against inflation.
Absolutely. They are a very powerful inflationary tool. We saw that in the April Federal Reserve Beige Book, where many managers worried about tariffs, and some are already seeing an increase in input costs just from the aluminum and steel tariffs, and that was before they were applied to European Union, Canada, and Mexico. So I would argue that they are a very powerful force that could, of course, create some headwinds for stocks. And that's why I would err on the side of smaller capitalization stocks, which will likely be less vulnerable, at least initially, to any kind of significant increase in protectionism.
And that's why we've been seeing the Russell 2000 continuously reach record highs, because companies in that index tend to have most of their revenues from the U.S. and not overseas.
Exactly. It's a scary environment because protectionism could be very, very problematic. We can just look back at the 1920s and 1930s as a cautionary tale. The problem is there's so many possible iterations at this point. It's not just actions, it's largely threats. And so we don't know exactly how this plays out. That's why I think markets are, for the most part, ignoring it. But that run-up in the Russell 2000 really indicates not just fear, but some understanding of exactly how this may play out in terms of what will be more insulated.
We have a couple minutes left. I want to end with one piece of advice or one major risk, either in the bond market or the stock market, that investors should be keeping on their radar, whether it's a black swan event or something that investors should be keeping in mind in the final 6 months of 2018, Collin?
Well, our advice is short and safe. Limit your interest rate risk. Don't be reaching for yields in those longer maturity bonds because they have higher yields, and don't be reaching for yield in the riskier parts of the market. Across most credit sectors, spreads, the relative yield you're getting is well below historical averages, and that just means there's less of a buffer if we do get some sort of market hiccup or pickup in volatility where yields rise, sending their prices lower. So short and safe.
All right, Kristina?
Dividends and diversification. Obviously, we're in the alliteration business, right? Well, dividends because absolutely stocks can offer significant income and they're tax advantaged. Diversification because that's absolutely critical in an environment like today, where there are a lot of uncertainties, risks are rising, but in general, there's an upward bias to stocks. And so to be very well diversified within stocks, within fixed income, but also be well diversified in terms of having exposure to alternatives, those asset classes that are lower or non-correlating with traditional stocks and traditional fixed income, makes sense in this kind of environment.
Any specific risks that could really wreak havoc on someone's portfolio for the final 6 months of 2018?
Protectionism and a hastening of balance sheet normalization, or even just the hastening that we will see that's already pre-planned, could wreak havoc.
All right. Well, it was a great discussion. We'll leave it there for right now. Kristina Hooper from Invesco and Collin Martin from Charles Schwab. Thanks you very much for joining us.
Thank you.
Thanks, Scott.
Thank you.